All right, good morning. Welcome back here to Trader Money. Great to have you aboard. A few things to go look at here this morning, but nothing that I think is overly market moving here. We are looking at a market that, yes, you guessed it, is set to open up flat here this morning. In fact, we don't really have a lot of movement in, in oil. We don't have a lot of movement in some of the other factors. We have a little bit of uptick in bonds, but let's go take a look. Earlier this week, I mentioned that there's not a lot of economic data, but some of the inflation data may be the most significant as far as how it affects, currencies and bonds, and therefore, some of the sectoral rotation in the equities markets. And this morning we had the PPI data released, and very interesting number. Year over year dropped from 3.4% down to 3.3%. This month over month change was expected to be 0.3%, came in at 0. Now, if you take out food and energy, which the Fed oftentimes likes to do, you still get a downtick from 0.3 down to 0.1. And year over year change, you get a downtick from 2.8 to 2.7. So a pretty interesting number in terms of a miss. In fact, if we look down here below, you can see that you can see how it has kind of fallen off here this month. And what's the significance? What's going on? Well, 1 month doesn't really mean all that much, but the direction of this indicator. So here we have two. We have month over month right up here, and the percentage change. You can see some months are down, some months are up, overall. But then down here below, we have, kind of the ongoing year over year. And, it's one of those things where the Fed raises rates as inflation goes up to try to control inflation. Inflation goes up because of economic growth. And the reality is we're still up over the Fed's target. Now, they don't use the PPI as their target. They use the CPI, which we'll see a little bit later. But a little downtick in inflation here this month. So it will be interesting to see how the overall market reacts here. If you look at bonds, you can see not a huge reaction here. A little bit of volume came in, a little bit of uptick in bonds. Generally, when inflation misses expectations, you're going to see a currency move, and we just really haven't seen much at all. So market's just kind of looking at it and going, okay, next, essentially there when it comes to the number, and we'll see how the CPI number goes, but. There's just not a lot of game-changing stuff out there overnight. We did see an uptick in China, which is going to help push the FXI higher. This morning, yesterday, I talked about an interesting day trade setup. If China traded higher overnight, the FXI traded higher overnight, and Caterpillar gapped up this morning. Be a very interesting day trade higher here. And I'll be looking at that. It may not be optionable because of how quickly it moves, but it certainly might be. And if I get that chance, I will look to take it there. But a little bit of strength in China. You can see the emerging market ETF pretty much, set to gap up, pretty much to where it sat an hour before the close yesterday. Here overall. So, just not a lot of news, not a lot of headlines. There's some news on Russia. We've continued to see some news on Russia, some sanction issues, but that started coming in at the end of the day yesterday, where the U.S. is putting additional sanctions on Russia for the spy assassination in the UK. So that's that's all playing out. That's all going on, but that's not overly market moving. But, not a lot of earnings for the market to pin on, not a lot of new trade war news for the market to pin on. And so with most of the metrics still being bullish, I kind of expect today to be very similar to most days that we've seen over the last little while. And, let's face it, even analysts, they're very quiet right now. I mean, it's crickets out of the analyst here As I kind of scroll through, as I kind of scroll through all the analyst commentary, it's silent. I mean, there's a few things on some really small cap names, but yeah, just nothing where you go, okay, this is, a positive for the market or a negative for the market. Oracle may be the biggest name that saw any analyst action, and this is a price target upgrade, but really didn't upgrade anything else, and they still have a neutral rating, so it's not really anything to write home about there with it. We did see one sector upgrade that could be of importance, and that's Morgan Stanley. They came out and downgraded the semiconductor industry, the SMH. This includes stocks like NVIDIA, Micron, Intel, Qualcomm, Cypress, those types of names. And you see the SMH set to open up lower here this morning. If you look at something like a Micron, set to gap down here this morning by about 50 cents, giving up some of its gains in the last hour yesterday. So if you're looking for a bearish setup, this is the type of bearish setup where, rallies into the close last hour and then on the open gives that up. That's a very nice bearish setup here. So there are a few things, within that space. But outside of that, fairly quiet, fairly silent here overall. Now, as I was kind of scrolling through the market, it was interesting kind of looking at a few things. And then one of you sent me a link, and it was a link to the front page of Market Watch. And I had seen this, but I didn't pay too much attention to it, as I normally don't pay attention to these front page blogs on Market Watch. They're generally riddled with a lot of holes, but sometimes they can be interesting. But I was sent this, asked for my thoughts, so let's go take a look at it. It says, "Behold the scariest chart for the stock market." All right. Anytime I see something like this, the first thing I know is this is a media company, and they're trying to drive eyeballs, right? What's their incentive? Is their incentive factual, or is their incentive to really just drive eyeballs? Well, their incentive is to drive eyeballs, right? And when you look at anything with CNBC, you look at things with Market Watch, you look at things with Bloomberg, yes, they have some positives, and there's some really good positives, but we do have to take some of this with a grain of salt, because it's an eyeballs game. They make money by more eyeballs and being able to sell more advertising as those eyeballs come in. So let's got to keep that in mind. But here we go. All right, we got our scared kitty cat here. And it says lots has changed since the stock market crash of 2000. Apple's gone from just being another computer brand to becoming the most valuable company in the world. Amazon went from being an ebook retailer to a byword for online shopping. And Tesla's Elon Musk has risen from obscurity to Twitter stardom. Okay, great, fine. All right, yet some things never change. Doug Ramsey, Chief Investment Officer at Luthold Group, has been on a mini campaign highlighting the parallels between 2000 and 2018. Among numerous similarities are the elevated valuations of the S&P 500. And you've heard me since day one of Trader Minute back in 2014? We were hearing talks of the market was overvalued back then, right? That was the big bear argument. Market's overvalued, market's overvalued, market's overvalued. And still today, it's the bear argument. Market's overvalued. We're 4 years later. And yes, there are some overvaluations, but, overvaluation doesn't mean you have to go down. But they bring up this chart here, price to sales. S&P 500 price to sales. So we have price to earnings, and then we have this kind of price to sales or price to revenue. Right? What's the price of the market relative to its revenues? And we can see back in 2000, back in 1999, the price to sales was up here around 2.2, and today it's at the same level. Must be overvalued, must be ready to come down. And, it says, hey, it's not as popular as the PE ratio, but it's viewed as less susceptible to manipulation. since it's based on revenue, and that's correct, right? But bottom line is basically make an argument that market's overvalued based off of price to sales and a little bit of other stuff down here below, and then uses this, well, the market could go down because of trade war, right? Which, let's face it, the market sees, and we need new unfolding in the trade war to create anything. And ultimately, trade war may be to blame for a next big drop. But, is this really a scary chart? Is this something to, take heed at? Is this something to have to say, hey, you know what, market's probably in a lot of trouble? Well, let's go take a look. I mean, I'm just going to come to a really simple site, multiple.com. Let's see here. There we go. All right, and this is put out by Schiller, who is Robert Schiller, who is a very infamous economist, and so we're talking about price to sales, right? So price to sales here, and let's see, price to sales ratio on the S&P 500, and this chart goes back to 2001, and we can see the price to sales on the S&P 500. It's up to 2.27, and it's the highest that it's been since that time period. And, okay, great. Right? So we're overvalued, right? Now, let's take a look at the context of a few other things. Let's go price to earnings, right? Let's go price to earnings. Price to earnings is at 24.78. Back in 2000, price to earnings was up in the 30s and the 40s. What's that tell us? Well, that tells us that the overall earnings of the market, of the S&P 500, must be at all-time highs. And here we are, 116.38 on the S&P 500, right? With it being in an all-time high. So we're not talking about revenues, a high price to revenue without earnings being solid in that, right? And in fact, if you compare the earnings to 2000, the earnings are over 50% higher than they were back in 2000. So this isn't one of those 2000 games where revenue, the hopeful revenue, but these phantom companies of, pulling in money but can't make a dime, losing money faster than the revenues are coming in. It's not that scenario here at all. When we start to look at some of the other metrics, and we can come in and put S&P real earnings growth right here, right? So if we come back to 2000, we come into some growth rates that were significantly higher and significantly more inflated. Right now, it's much more of a normalized kind of average market type of earnings growth in terms of the real earnings growth. If we look at sales growth, yes, we have high price to sales, but we have sales growing and continuing to grow. We've just come out of a recession from a revenue growth standpoint on the S&P. 2016 and 2017 were recessions for revenue growth, and we've come out and gone into that positive revenue growth period. And, we did that back here in 2010, and the markets had, obviously a lot further to rise. You'll notice back here in 2003, revenue growth turned positive. Those have been times where we've seen sizable escalation in the market. And if revenues are growing at a sizable pace, it's going to justify a higher valuation because the market's looking forward. Market's saying, well, wait a minute, what's going to happen next year and the year after, right? Yeah, you might have great earnings now, but are you going to be able to sustain it? If you are, okay, great, we'll buy you. If not, we're going to sell you. And we've seen that this earnings season, right? Yeah, so there's some concerns with the market, sure. Some of the participation rate, I think, is concerning. But it's one of those things where right now, these are not market timing things. These are long-term hindsight wielding. Yes, you should have sold back here. You should have bought back here because of this. That's what these are. And for me, they're much more of a just understanding the landscape and the risks. And so, yes, price to sales is high. Right? Absolutely, it's high. But earnings are at all-time high, and we have revenue growth that is more substantial than it has been in many, many, many a year. So, anyway, that's my 2 cents there on that. As far as what does it mean to trading, absolutely nothing. Just nothing in terms of that. And, I know these types of articles and things like that create some emotions, but almost always, whether they're bullish or bearish, they're riddled with some serious holes that just don't add up and make it so it's, look, if you're trying to react to every one of these types of things that's out there, it just becomes, quite a nightmare. Quite a nightmare. All right, so anyway, my 2 cents. During the day today, you'll hear me jump on video a couple times, just recording a few videos that are going to go in the must-watch video section here of Trader Minute. So we'll be doing that. We'll be looking at a couple topics with that. Let me grab those here for you if you're interested. Let's go. Number one is going to be the mechanics of a challenge trade, and all these are going to be about 5-10 minutes. Second is going to be the trading philosophy behind challenge trades, and the third is going to be revolved around TM signals, the market vibe, Katie, trend rider, trade signals, and so we'll be doing that here today, probably about an hour and a half, 2 hours after the market opens, and when things kind of settle out, when I've made the decisions that I want to make personally and for the challenge. So we'll be doing that throughout the day here today, and getting ready to start the next challenge and looking at things. And when do I start the next challenge? I'm kind of aiming for Tuesday next week is what I'm aiming for. I'd like to be in a position where I'm starting a challenge when things are going to move. When we're going to get some action, not when things are just kind of lazy, low volume, sideways action. So, targeting kind of next Monday afternoon, Tuesday, somewhere in that time period. Until then, as I see trades, I'll make them. I may make Caterpillar trade here today with just kind of the little weekly challenge here. But anyway, we'll be doing that. All right. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you later. Take care.